Socrative, Section 4, Cost, Volume, Profit. This is Level A. Now, a company sells a product which has a unit sales price of 9 and variable cost of 6. So therefore, the contribution margin is $3. 9 minus that. And they have total fixed cost of $60,000. How many units? Well, break even would be 60,000 divided by 3, and the answer here would be 20,000. A company has total fixed cost of 180 and a contribution margin of 30%. How much in sales do they need to break even? So if I want total sales dollars, I use contribution margin ratio. If I want units up here, I use the contribution margin per unit. So here we have then fixed costs of 180,000. Break even is equal to fixed costs divided by a contribution margin ratio, which is 0.3. And the answer here is $600,000. All right. Sark's company has a contribution margin ratio of 150 and a contribution margin total of 150 and a ratio of 30. But they want to know the variable cost. Ooh, that's a little tricky here. Well, we need to know the sales so we can subtract the variable costs. We can subtract contribution margin and get the variable cost. So if we say let X equals sales. Now, we know then that the contribution margin is going to be 150,000, and is divided by 0.3. So therefore, X is equal to 500,000. And if X is 500 and the contribution margin is 150,000, then the answer here is 350,000. 4. How much sales are required to earn a target income of 80,000 if the fixed cost is 100 and the contribution margin rate is 0.4? So therefore, sales required, we'll just say it's equal to the fixed cost plus profit divided through, we want sales, so the contribution margin ratio 0.4. And when we do that, we get an answer of 450,000. Number 5, Saver Company produces only one product. Monthly fixed costs are 12. Monthly unit sales are 2,000. Okay, the unit contribution margin is 10. How much is the profit? Well, total contribution then. Go right with the contribution margin. Total contribution, 2,000 units, and I'm making $10 on each. So total contribution is 20,000. That goes to cover my fixed cost of 12,000. And what's left over is profit. So the answer here is 8,000. Schnuppner Company sells its only product at $18 per unit. Variable production costs are 6 per unit, and selling in a mint are 3. So both of those are variable. So the total variable cost is 9. The selling price is 18. The variable cost is 9. And the fixed cost is 10. Okay, but they just want to know what the contribution margin ratio is. Well, it's 9. There we go. 7. The contribution income statement highlights gross margin. No, gross margin is sales minus the cost of goods sold. Highlights product costs and period costs. No. Different product lines? No, that makes no sense. Highlights the variable and fixed costs. The answer here, the only answer is D. Break-even point is the total cost divided by the variable. No, that makes no sense. Contribution margin per unit divided by the revenue per unit. No, that doesn't make any sense either. Fixed costs divided by the contribution margin per unit. Yes. The sum of fixed and variable. Well, the only answer here is C. The following information for Nichols Company. Selling price, $150 per unit. Contribution margin, or variable cost, $90, so the contribution margin then is $60. Sales, $150 minus $90. Fixed cost of $300. Okay, what do you want to know? The number of units, okay, that must sell to reach a target operating income of 90. So therefore, number of units is equal to the fixed costs. Got to cover the fix, plus give me 90,000. And I do that with a contribution margin per unit of 60. And therefore, my answer, when I work that out, is 6,500 units. So I say that. Okay. And number 10, the margin of safety is the difference between budgeted or forecasted expenses. No. Budgeted or forecasted revenues and the revenues I need to break even. Yeah, that's true. Actual operating income and budgeted? No. And actual contribution margin? No. The only answer here is B. And that's it for Level A questions. We move on to Level B, a little more challenging.